Hello, welcome. We're gonna continue our series that I started some time ago, and we're talking about ARKK, the well-known Cathie ETF from their ARK innovation, really, is what she calls here ETF. And I'd say hype. I would probably substitute that with hype. But we have already examined Tesla, Roku, and Teladoc in the previous videos. And now we're going to continue with the fourth largest holding of hers, which is Zoom Video, a very well-known company that has a product that I really enjoy myself. Like, I really like Zoom, and everybody has been using it, and especially within companies, I know that it's a very big thing. But let's examine what Zoom is actually doing financially, and we'll also take a look at discounted cash flow model that I have built for that, and we will examine it at the end of the video. But first things first, thank you for being here. Hope you enjoy this content. If you do like it, please leave a like, because that really helps, and subscribe, because there's gonna be a lot more coming up for you, including a new tool that we can use to analyze, and it's gonna be exclusive for the channel. So in this one, we're examining Zoom, and the first thing that we want to see here is the outstanding shares sitting at approximately 300 million here, and they're creeping higher, creeping up, just because I guess the company wanted to make some money during this run, and so they were issuing more shares to all those investors who were willing to buy. But you will see that the company is actually featuring a 30 times PE here, which in the next 12 months, that is, which is probably okay. Like a 25 to 30 I would be okay with, but still I want to examine the company's cash flow and see whether it does make sense for me to enter here. So the next thing that I want to examine is income statement. And obviously the company's price has fallen off a cliff, and so it's down like 65%, and it could have been overvalued. But the question is it overvalued now? Like, not everything that Cathie Wood is holding is overvalued, although that's for the most part what she does. But at some point, when they come down that much, maybe we can get something at a fair price. So this is what we're examining. And the year-over-year growth of total revenues here is pretty nice. I mean, the company seems to be growing its revenues a lot. And 325 was 2021. And the last 12 months stalling a little bit. You would kind of expect that. The majority of the growth happened in the pandemic, during the highest phases of the pandemic, I should say, because you would expect everybody to be working from home and all that. So communication, very important thing. And the other thing that I want to see here, of course, is the net income. And the company has been growing its net income nicely. Now, the worry that I have about this company is what's going to happen after the pandemic. I think they will continue having some good years and producing good cash flow, but I'm not sure whether they will be able to continue at this rate, just because, during the pandemic they had the extra people staying at home, and all those companies that needed this kind of communication tool. Although, to be fair, I know of companies that were using Zoom way before the pandemic, so it's a very direct competitor to WebEx, and Zoom, in my opinion, is much better. So I think they can keep doing very well, frankly, but we'll see. It may be one of those companies that it could be beneficial for you to wait a little bit and see what's happening in the next year or so. But next two things that I want to examine here, the total liabilities of the company sitting on $1.8 billion here, and that's both current and non-current liabilities, so about $2 billion. But the total equity of the company is at $5 billion, which means that they have about twice as much, almost 2.5 times as much equity as liabilities, which is very nice. Cash flow. The cash from operations is also increasing, and again, 2021 was a rockstar year really for them. And what did they do with the extra money? It looks like they keep investing, and even in the last 12 months, even more and more in market securities. I like to see that. I like that the company is investing in the market, but you'd have to bear in mind that when a company does that and is neglecting its own operations, what they are doing, especially in this company where we examined already that they have been issuing shares, they are taking money from investors from the market, purchasing their shares, and depositing these shares to other market securities. So they're almost like a hedge fund for you. So you have to understand that, and that's important. Now, that doesn't mean that's bad, But I want to see, if I'm investing in a company, I don't need a hedge fund manager to invest other assets, my assets for me. I can do that myself. I want a company to actually be doing well. And so I would want them to actually use their cash flow to invest in the company itself. Like you see, sale of property, plant and equipment here, cash acquisitions, everything is actually null here. So there's nothing happening apart from market securities. So bear that in mind. We are looking at a company that's really acting like a fund manager. So keep that in mind. Cash from financing. This is positive here, which means that the company is issuing stock, and that is what we saw. It's the thing that we saw earlier. They are issuing stock. Investors are paying for that, and then they are using the funds to actually buy market securities, other market securities. So, I don't know how much you like that. I'm not a big fan. I like companies that invest in the market as long as they invest in themselves too. I don't want them to be issuing shares, heavily diluting me, and then getting my money and investing my money in the market, because I can do that myself. So, the free cash flow of the company from 4.5 million to 1.6 billion, that's impressive. That's absolutely impressive growth from 2017, massive. So it does make sense that the company ran for quite some time, really. The multiples are relatively high here, but you look at that, wow, it's like 50, 40, 30. This is much, much better. I'd like to have it a little bit lower, like 3, 4 or something, but still way, way better than these insane values over here. The profitability, this is great. Return on equity of 35%. Wow, that's absolutely awesome. So the company is actually using equity, and equity includes debt as well, to return money to investors, to shareholders, and this is the return on investment from shareholders. That's great. 35% is really, really good. And solvency, there's basically very little debt compared to equity here. Company has very, very little debt. So these are all good. But let's take a look at the cash flow of the company. And I have already pre-populated the fields here. And I'm going to use a discount rate of 13%, which I think is fair for this kind of company. Now, the free cash flow that you'll see here is like 442% if you average it in the last 5 years, which is, of course, not sustainable. So we're going to go for a relatively high free cash flow growth regardless, because I think actually Zoom has the potential to achieve that kind of growth. So I'm going to go for like 17% here, which may be a little bit high. But again, I think they can potentially do it. And I like to use 1% for the perpetual growth rate here. I've already pre-populated the outstanding shares, which is about 300 million. We examined that earlier. And you will see that the price per share to pay today in order to achieve 13% a year for the next 10 years is $112.45. And the current price of the company is 130. So it's relatively close, but still we want to get it at a little bit of a cheaper price. It may have actually reached 112 at some point this year. Let me actually quickly check that. So it used to be 114. Yeah, 114 is what was the low over here. So at that price, I would like it much more, of course. But if you are willing to potentially gamble on a 20% free cash flow growth per year, that may be a little bit too much actually. But if you are willing to do that, then you are getting a $137 entry point, and this is actually where we are at, right? It's actually a little bit less than that. So you kind of see here how we can play with the values and see what we want to be achieving and what are our assumptions for the company and what could potentially happen. I think that's probably a little bit excessive. I would be much, much more willing to go with like something like 17%. Again, because this is also a 10-year projection over here, so it's much, much deeper into the future, and so you can make more mistakes and be more off if you go that far. So that's what I wanted to say about Zoom. Of the companies that we have examined from Cathie, this is the easily the best one so far, and that's probably because it has really fallen off a lot in price. Because the other ones, Tesla, Roku, and T-Doc, were actually very, very overpriced. And this one also overpriced at some point, like over here was massively overpriced, but it has dropped a lot. And so now I think it's actually close to being fair priced. And actually, it was actually relatively fairly priced over here in 114, I'd say. But even at these levels, you may want to think about it and maybe build a little bit of a position. I wouldn't be against that. I mean, it doesn't look too bad to me right now as it is. So hopefully you enjoyed the video and it helped you a little bit with understanding how Zoom operates and what they're doing financially. If you did like it, please leave a like. That really helps bring the content to more people and helps me make more videos. And if you did enjoy this one, you may want to take a look at the video that I made earlier. It's about BP, the oil company. Interesting one, a European company. You may want to take a look and see whether you would like to build a position on that one. Thank you for watching. See you soon. Bye-bye.